Good afternoon, ladies and gentlemen, and welcome to our virtual panel discussion, which brings to you an investor's guide to Balanced Advantage Fund. Now, if you're wondering what is a Balanced Advantage Fund, let me quickly give you the basics. Balanced Advantage funds are hybrid mutual funds which invest into equities as well as debt, and there are no caps on the asset allocation. Now, these funds also offer the fund manager the flexibility to change the asset allocation as per changing market conditions to balance the portfolio. So, when capital markets are doing well, the portfolio can be tweaked to include more equity exposure, and when the markets are volatile, the funds can be parked into fixed income instruments, which are considered to be safer investments in comparison to equity markets. So, this is why they're also called the all season fund. Now, the basic assumption made with an investment in balanced advantage funds is that these will help contain the downside of a bear market, even as it allows you to participate in the upsides of a bull run. So, let's know more about these funds. I'm your host, Gautam Srinivasan, and today we have with us Srinivas Khanolkar, Head of Marketing Strategy and Communication at Mira Asset Investment Managers India Private Limited, and Mohit Gang, co founder and CEO at Moneyfront. And both these gentlemen will shed some light on balanced advantage funds and, of course, explain whether they really live up to their tag of being all season funds. Srinivas, Mohit, great to have you on board and looking forward to understanding in detail about balanced advantage funds because they sound like such a great product, especially when there is uncertainty in someone's mind as to how to go about investing. So let's start with the basics first of all. Srinivas, if I could come to you, I've given a basic explanation of what balanced advantage funds are. If you can expand on that.
Thanks, Gautam. Thank you for having us today. Indeed, it's a very special category, something which has become very popular over a period of time. And with markets at these levels, there are doubts in investors' minds. So, having a session like this at this time maybe would do a lot of good to investors to understand what could be their next course of action. Balance advantage funds are very popularly known as BAF, a type of mutual funds that are aimed to provide investors with a balanced mix of equity and debt instruments, and they are managed in a very dynamic portfolio management way, right? BAFs are popular as they provide flexibility to adjust the exposure to the underlying securities basis market valuations at various points of time, whether it's market valuations, interest rates, or any other macroeconomic factor. That's what the balance advantage funds as a category to bring to the table for the investors. So yes, I think as a product, it's become very, very popular. As the name suggests, it balances a couple of asset categories for the investors, and that left the job is left for the investor, for the fund manager to do.
Absolutely. As they say, you need balance in everything, whether it's life or in investments. So let's take that conversation forward and ask a question which many folks might be thinking, especially when they hear about balanced advantage funds. And the question would be, how are they different from balanced funds and hybrid equity funds? So, Mohit, let me bring you into the conversation to answer that question.
Thank you very much, Gautam. Look, I'll just quickly add on to the balanced advantage category. To me, it's a perfect blend of the best of all worlds, right? Now, imagine a work-life scenario where your HR manager in your organization tells you that I will dynamically manage your work and life as in work and non-work life, right? So when you are overstressed, they give you extra hours to spend at home, and when you are under stress, you're feeling fresh and you are completely rejuvenated with your family life, they'll give you a little extra work, right? So it's like dynamically managing your workload. Just imagine the scenario, how happy an employee you would be, right? And that's exactly the concept which has gotten into this balanced advantage category. They dynamically manage the best of all worlds, which is equity and debt. Now, how is it different from a balanced fund or a hybrid fund? There are very minute differences, to be very honest. A balanced fund is a more static composition of equity and debt, unlike a balanced advantage, which is dynamically managed. And as Srini rightly said, basis some macroeconomic factors, or some equations or some algos which each fund house can define for themselves. What is a hybrid fund? Now, hybrid fund is again a static kind of an allocation between equity and debt, but where the equity composition can vary depending on the category of hybrid. So it could be a conservative hybrid where the equity composition is fairly minuscule, say less than 25%, or it could be an aggressive hybrid where the equity composition could be higher than 75 odd percent, right? So those ranges are kind of defined in hybrid. In balanced, the overall composition between equity and debt is defined. In balanced advantage, you get that advantage that the fund manager is playing from your side and is trying basis certain macro factors or micro factors to dynamically adjust your work life balance, or so to say your equity and debt composition.
All right. The key differences between balanced advantage funds, balanced funds, and hybrid equity funds simply explained to our viewers by our experts. Let's take the conversation forward, especially on this dynamic adjustment aspect. Srini, let me bring you back into the conversation. If you can elaborate more on the dynamic asset allocation aspect of balanced advantage funds for our viewers.
Yes, Gautam. I think among all the types of mutual fund schemes that are available across all the categories that have been defined by SEBI and one mutual fund houses can launch, BAF is the only scheme type which allows you flexibility of to move 0 to 100% between equity and debt. So there aren't many categories which are able to do that. And if you look at it, the asset allocation in the balance advantage fund can change dynamically and automatically based on some predefined quantitative models. For instance, if you look at it right now, if equity markets are performing very well and the valuations have become really sort of expensive, then the fund manager has the opportunity to sort of increase the debt portion and try to preserve the fund value as per the market valuations. On the other hand, if the valuations have become cheaper or the markets have not been doing that well, then he has the opportunity to increase the equity side of the portion to capture potential gains which could arise. So if you look at this category and the way the dynamism of this asset allocation, these vary from fund houses to fund houses and from each balance advantage fund launched by each fund house. And this is typically outlined in the front funds prospectus. So if you read the said properly, then the what is the nature and what is going to be your mechanism to keep moving the percentages basis market valuations are well defined. So each fund house will have it differently, and it's important that that's looked into by the investors before they decide that which sort of dynamic asset allocation actually works in their favor.
Any points for investors to remember, Srini, especially as you mentioned, right? Each fund house will treat that product differently. Anything, any advice you would like to give to investors who say now know a bit more about balanced advantage funds and want to explore more? But with shopping, you always need to know what are the points to look out for. So, anything you would like to suggest? Anything to keep in mind? Any myths to debunk?
Um, that's a great question because, first of all, one has to look at the benchmark of the product, right? And popularly, most of the balance advantage funds which have been launched in the country so far either follow the Nifty CRISIL index or the Nifty 50 hybrid composite index, or they follow the CRISIL composite index, which has both 50-50 on index and debt, and that has a risk flag of say not very high. It has a high risk flag and not a very high risk flag. So that's one point you need to look at, and then compare the scheme riskometer. Where does the product stand? So basis the benchmark of the product, if the fund's riskometer is one notch higher or one notch lower, that is a good sort of indication as to how the asset allocation strategy of the fund is being played out. So that's one. Second, of course, is over a period of time, you will have the performance sheet comparisons for the products for investors to look at and to realize that what is the equity exposures, what are the debt market exposures at various points of time. And of course, it is then on the fund manager's ability to how does he maneuver during times, and how does he ensure that the dynamism of the product is kept um, into the play given the market conditions. So there are a few you know ideas where the investor can look at and decide where he wants to then go and invest. But as we said, the first thing is the investor has to figure out whether this category does really do justice to what he wants to do.
Absolutely. Ways to prepare your shopping list. Coming to you, Mohit, for your thoughts on this, especially considering an addition to what Srini had mentioned, if you have a point there, and also because investments are usually in a portfolio for an investor, where since the investment universe has expanded, there are lots of products sort of jostling for an investor's attention into their goal sheet. So, from that perspective, from the perspective of an investor and their portfolio, what are the benefits of an investment in balanced advantage funds?
Sure. Thanks, Gautam. So I'll just add 3 points to what Srini mentioned. And of course, Srini has kind of nicely outlined what an investor should look into. But I think there are balanced advantage funds and then there are balanced advantage funds. So there are minute differences which an investor has to be very discerning about. And to me, three are of utmost importance. Number one, what's the formula which a fund manager follows for his balanced advantage fund? So sometimes it's just the market valuations, which could be a plain P ratio methodology, which predominantly most of the fund houses follow. Or sometimes it could be a combination of P plus PP and a subjectivity layer by the fund manager. Sometimes there could be a valuation plus a technical methodology. And all balance advantage funds, trust you me, have a very different methodology to figure out the ratio of equity and debt. And when would they dynamically change the allocation? Would they do it every month? Would they do it fortnightly? Would they do it quarterly? Is again of utmost importance. The second point here is the equity composition. What kind of an equity composition does the fund manager play, right? So is he more a mid cap player or is he more tending towards large cap in the equity composition? That also will determine what kind of profile of investors would want to fit in into a particular balance advantage fund, and how the fund manager is actually dealing with the underlying equity portfolio. And the third and final point out here is again on the debt side. Look, debt as a composition will always be there between 20 to 30, 35 odd percent in most of the balance advantage funds, and sometimes more. So what philosophy is the fund manager adopting for his debt portfolio? Is he going very safe and just planting his funds in the short end of the category, or is he trying to go the medium range or the long end of the curve and trying to play the interest cycles, and is he dynamically playing around with the debt portfolio? So these three criteria to my mind are extremely important. What was the second question, Gautam?
The second question is its suitability in an investment portfolio for the average investor. About balanced advantage fund, where does it fit?
Look, I think if I'm an investor who doesn't want to like really break my heads on my asset allocation, who doesn't typically follow the financial rules, or I'm not very conversant with dynamically changing my debt equity allocation and being on the top of the market, or even my portfolio for that matter, then I would go for a simply a formulated method. And balance advantage is nothing but a formula driven method where I don't have to bother about my asset allocation, but the fund manager is automatically trying and taking care of that asset allocation depending on the market levels. Obviously, my risk profile can go haywire in that and might not match with the asset allocation at certain points in time, but I am kind of relieved of the overall duty of managing the debt equity mix in my portfolio. So that's one kind of a profile which would find extremely useful allocation in balance advantage. Second is obviously for retired category, I have seen balance funds and balance advantage funds, or a section of hybrid funds have immense utility, because their final goal is to safeguard their capital to a larger extent and have minuscule growth, right? They want lesser volatility, they want reasonable growth, and they want some safety net built on their capital. So as a concept, I think balance advantage funds does all three. They preserve they preserve capital to an extent, not completely, obviously, because there is an equity composition, and obviously they lessen the overall volatility of the portfolio. So I think that category also finds a use case in this profile. So there are, to my mind, there are many profiles who can actually find suitability out here in this category.
Absolutely. And I'll extrapolate some of those points in the context of taxes, because death and taxes are always constant. And any discussion on investment has to include that prospect of taxes. Mohit, I'll come to you on that aspect. But before that, Srini, let me ask you this point on when we talk about the safety net. Every investment does come with an element of risk, and especially with the market, we get taken in by lines like risk hai to ishq hai. So can you detail what are the risks involved in this product for our viewers?
Yeah, risk is an important aspect of investing and delivery of returns, right? Without which it's going to be difficult for any investor to understand where does it go. Typically, investing in capital markets has largely two types of risks. One is the market risk and the interest rate risk, right? One for equity and one for debt. Let me elaborate a bit on both of these before I go to what is the other type of risk which is associated with this category specifically. A market risk, as I think everybody would understand, funds are subject to market fluctuations because of the underlying investments, and equity buying nature is going to be volatile. There are going to be ups and downs in the stock markets. During the bearish market conditions, the equity allocation could lead to valuation corrections, right? So your values would also go down. So that is the market risk that the product brings in. The other side is because it also invests in debt instruments, there's going to be interest rate risks. So the debt components of these products are going to expose investors to interest rate risks, and which is going to come because of the debt securities which are part of the portfolio. This could also lead to potential mark-to-market losses, or in case if there is any credit incident which happens, then the principal is also at risk. But at large, these are the two types of risk which come with capital market investing. Now, with the balance advantage fund, typically there is one more risk which is associated, which is the dynamic asset allocation risk, right? Where the fund relies on the effectiveness of the formula which it's going to work on, and the fund manager's asset allocation decisions. If the fund manager's predictions are about market movements and the allocation adjustments are incorrect, then it could lead to underperformance compared to its benchmarks. So, like I said, that going back to my previous answer, that you have the riskometer, and there are two riskometers which are published with every product. One is the scheme riskometer and the benchmark riskometer. I think it's a good guidance tool for any investor to understand where does one particular fund style is positioned compared to its benchmark, and that will also underline and bring out the different type of risks which are associated.
Absolutely. Points to keep in mind. Bringing the conversation back to taxes, Mohit, let me bring you in, because balanced advantage funds can be taxed as debt or equity funds basis their asset allocation. So I want to know from you which option of the two is more beneficial to maximize returns.
Okay, so look, I'll first get into the taxation for balanced advantage fund. Now, taxation in most of these hybrid categories is a little tricky, and it all depends on the final underlying equity composition and what the fund has maintained on a weighted average basis throughout the year, right? So every fund house at the end of the year will perhaps declare that my weighted average equity composition for this year was, let's say, over 65% or 70% or 68% or whatever. So if the number is greater than 65%, which typically most of the balance advantage funds will keep, then you fall into an equity tax category, and which is what most of the funds will strive and endeavor to do, to get the investor into an equity tax category. They will keep the equity composition over 65%. So then the taxation is fairly simple: 10% long-term capital gains for holdings above a year, and 15% short-term capital gains for holding less than a year. And if you have long-term gains, then obviously the first 1 lakh is exempt from tax. But if the composition is less than 65%, then the taxation gets a little complex out there. Between 35 to 65%, long term is defined as greater than 3 years, and then you get indexation benefit, and the gains are taxed at 20%. Less than 35% equity composition, it falls into debt category, and there's no short term long term now in under that category, so it's all clubbed in your income and taxed at your marginal rate. But again, just to clarify a bit, all balance advantages funds, to the best of my knowledge, will keep the equity composition above 65% and give you that equity tax advantage, basically. In comparison to balance funds and hybrid funds, there's only one category of hybrid funds, which is conservative hybrid, where the equity composition will fall below 35% or maybe between 35 and 65%, and you will have to appropriately categorize into that scheme into a certain tax bracket. But otherwise, I think predominantly the fund managers are also smart, and they know that tax effective returns are what gets counted, and hence I think they'll keep it above 65%.
And to add in, Mohit, the factors that should be in play for determining the ideal duration of a balanced advantage fund in a portfolio, anything for our viewers to keep in mind?
Look, Gautam, whether it's balance advantage or any kind of advantage or any kind of equity funds, the ideal duration to my mind is forever. And unless you have a very specific liquidity requirement. But if you're specifically asking that question, minimum 3 years is what I think these kind of categories should be kept. A tad lower than what an equity recommendation would be. I think equity is advisable above 5 years, given the levels at which markets are and the volatility, which has become part and parcel of the market cycles now. I think 5 years for equity and maybe 3 years and above for balance advantage category would be an appropriate duration.
All right, we're almost out of time. So let me ask the last question to the both of you. Now, Srini, as you mentioned, the success of a balanced advantage funds, it depends upon the strategy also deployed by the asset management company in terms of where the funds are allocated. So in a sense, creating a mental bookmark for our viewers of all the points discussed, what in your opinion are the factors that should be considered before investing into balanced advantage funds? Recap some of your points for us, and then we'll come to Mohit for the last word.
Well, I would like to make it very clear for the investors that look at balance advantage funds as not something like an hybrid product I must have in my portfolio. It's a participation product. It gives you participation to equities at all points of time. So uh, there's no point confusing this with a wealth creation generation sort of a concept where like what Mohit pointed out, that equities is for 5 years and this product could be 3 years. This is a participation product. So when you when as investor is coming into this product, remember that they will have it, equity exposure at all points of time in whatever percentages, whether it's 10%, 20%, 40%, 60%. Like, I'll go back to my first answer that this is probably the only category which gives you a 0 to 100% exposure on both sides. So you would always, most likely, the fund managers would keep certain percentage of the allocation to equities, and hence it's a participation product. Second, do remember it will also carry risk because it is investing in capital markets. Risks are not only in equity but also in debt. So, but obviously they're not as high as entirely 100% equity portfolios, right? So, and the third thing is, do take your time out to check each prospectus to know what is going to be the methodology for the fund manager to do the investments in this category. As Mohit pointed out, each guy, each fund house, each fund manager, and each product will have a slightly differentiated strategy, and hence each product would be different to each other, although they all classify under the dynamic asset allocation or the balance advantage funds. So,
All right.
participation product, that's the key line.
All right, participation product. Let's expand on that and get in the final statement from you, Mohit.
I think beautifully put, Bashini, participation product. And I would like to add that, look, you want to participate in this category if you want some portion of your portfolio to be really moderate. not overtly aggressive and not absolutely conservative. You want a middle path, so to say, right? At the end of the day, for an investor, the whole objective is to cross the swamp and not fight the crocodiles. And I firmly believe in that, right? So you don't have to like aggressively chase equities when equities are doing well, and aggressively go into debt when the interest rate cycles are peaking and you think the cycle will reverse, or so on and so forth, right? Your whole idea is to cross the line, go to the shore, and achieve your financial goals. And if you want to do that, getting this product in your portfolio for that moderate touch of both equity and debt could be a winner, right? So every portfolio, to an extent of 5 to 10%, could have this kind of an allocation. It also gives you a bridge between the two categories and gives you some dynamic movements, and you can always track whether it's been a successful strategy, and then you can try and apply that to your overall portfolio, that whether rebalancing your portfolio between debt and equity does make sense or not. And it gives you a real life experience or a real touch and feel of how that could be done.
Well, hopefully, all of our viewers have enough information to start on this journey of balanced advantage funds and see how it fits in their goal. All the markers for all the shopping lists that they need to have in place to make that decision, well, hopefully, has been provided during this discussion. But we're almost out of time. We're actually out of time right now. So we'll bring this conversation to a close. Srinivas, Mohit, thank you so much for joining us. And of course, for sharing with us your insights and lessons. And before we sign off, I'd also like to thank Mirae Asset Mutual Fund for partnering with us for today's session. We'll be back soon with yet another discussion on smart investing very soon. Till then, stay well and take care.
Thank you.
Thank you.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.